I have some extra cash flow, so I should use it to pay down my loans, shouldn't I? Hey everybody, it's LaVoy with Telos Financial. Thanks for checking out my video blog today. Today I'm going to talk about different scenarios. If you have extra cash flow and you have loans, should you use the money to pay off your loans as aggressively as possible? Today I'm going to talk specifically about student loans, but if you have other types of loans, the rules do apply pretty generally. You need to consult a financial planner before making any personal decisions, review the options, educate yourself, and make an informed decision. So I'm going to talk about 3 scenarios where it might not make sense to pay off your student loans as aggressively as possible. We're going to talk about if you work in the public sector versus private sector. We're going to talk about generous employers, and I'm going to talk about taking on some risk and investing in the market. So the first scenario, let's say you work in the public sector. There are certain companies in the public sector that qualify for federal student loan forgiveness. You have to work for a qualifying company for 10 years. Of course, there's some risk involved with this because 1, it's on the chopping block politically. 2, you have to sort of file annually and you don't really know until after the 10 years if you've qualified for the forgiveness. But it's something to be aware of. And if you work for one of those companies that is on the list that qualifies, it probably makes sense to make the minimum payments because at the end of the 10 years, the debt's going to be forgiven. Any extra money you dumped in there would be down the drain. The second scenario, if you have a generous employer who might help you with your student loans. This is a little more rare example, but it does happen. If you have especially in small companies, you have a generous employer, it might be mutually beneficial for you to continue your education. And if having student loans is prohibiting that, your employer might help you pay off your student loans in order to be able to get more education. Again, it's a rare case, but if you work for a small company, have a generous employer, it's something worth pursuing. Student loan debt, I think, is pretty widely recognized as an issue. So if your employer is conscious of those things and willing to have that discussion with you, I'd definitely do it. The third scenario I want to talk about is if you're willing to take on some risk. Student loan debt or loan debt in general is guaranteed interest you're paying. So, there are a few things in investing that are guaranteed. When you're making loan payments, that interest is guaranteed. Let's assume in this example you have $20,000 of student loan debt. It's at 5% interest. The minimum payment's $200. And in that case, it would take you just under 13 years to pay off those loans. So I'm just going to say 13 years for purposes of this discussion. Further, let's assume you could earn 7% in the market, which again, depending on your risk tolerance, may or may not happen. There's no guarantees in the market, but we're assuming you're taking on some risk here, so assuming a long time horizon, things average out. So let's say you have $1,000 extra per month you can do something with. I want to look at 3 scenarios with this discussion. First, you take the $1,000, put it all towards your student loans. In that scenario, you'd pay off your student loans in 19 months. That is fantastic. Kudos to you. One, having the extra cash flow and devoting it to something like student loans requires a lot of self-control, requires budgeting. It's great. It is a phenomenal accomplishment. If that's your number 1 priority, it makes a lot of sense. The second scenario I'm going to discuss is if you took $500, put it towards your student loans, 500 of that 1,000, and invested in the market at 7%. In that scenario, you're still paying off your student loans way early, 31 months, which is a huge accomplishment, again, over the 13 years, under 3 years, and you have some money saved, and then you're still way ahead of the game. And the third scenario I'm going to talk about is taking the $1,000, just investing it in the market. Clearly, you're still paying it off in 13 years, paying the most student loan interest in this case, but obviously you're going to have a bigger pot saved at the end. So in the first case, you take the $1,000, pay off your student loans in 19 months, and I want to look at a 3-year time frame, 36 months. So then from months 20 to 36, you're investing that money, again, assuming 7% compounded monthly. In that case, at the end of the 36 months, again, your student loans are paid off after 19, you have invested it, you'd have just over $17,000, almost $18,000 saved. It's great. Again, great accomplishment. Great strategy. It's really cool to look at these scenarios and how fast the money grows. Scenario 2, you put $500 towards your student loans, $500 towards investing. Again, you pay off your student loans in 31 months. Then at the end of the 31, from 31 to 36, you invested the full 1,000. In that scenario, at the end of 36 months, you'd have over $24,000 saved. because you're investing over the full time, you were paying off student loans. Yeah, you paid more in student loan interest, but at the end of the period, assuming a flat growth rate, you ended up ahead at the end because you're investing for longer. So in the third scenario, you take the full $1,000 purely invested in the market. In this case, you're not paying down the student loans early at all, so you're paying the most student loan interest over the period. You're going to carry the student loans much longer, which may or not be the goal, but at the end of the period, you're going to have the highest investment bucket left. So in this case, at the end of the 36-month period, you'd have about $15,000 to $16,000, about $15,500 of debt left, but you'd have over $39,000 invested. Is that the best solution? I don't know. It depends on what your goals are. You could easily cut a check from that savings, pay off the student loans at the end of 36 months. You're still ahead in the end. But again, it depends on what your situation is because you're taking on some risks. It's hard to say what's right for you without looking at all of your goals in whole. So today we talked about 3 situations where it may or may not make sense to use your extra cash flow to pay down your loans as aggressively as possible. 1, if you work in the private sector. 2, if you have a generous employer. And 3, depending on what your risk tolerance is and what your goals are, your personal situation may or may not dictate that it is the best option. So that's it for today. Thanks for watching. It's Dennis LaVoy with Telos Financial. Make sure to check out my website for more information, more videos, and to schedule an appointment. I look forward to seeing you soon.